of the questions at the end of mock exam number one, and it is telling us that a business, perhaps Adidas, okay, is going to diversify its operations to start potentially a range of personal products, including deodorants and aftershave. And we know that the main business of Adidas to point has been sneakers and shoes and clothes, that kind of stuff. So the first thing they're asking us to do is suggest two possible approaches of how Adidas might estimate its cost of capital, equity capital, for this new range of products. Okay, and the important point here that the professor is looking for, okay, is that the current weighted average cost of capital for Adidas would not be relevant, okay, to a new line of business. And the reason that it would not be relevant is because Adidas is an established company, okay, whose name is in the market and people know it, and they know the risk associated, okay, with Adidas' current products, okay, and potentially, if Adidas, let's say, were to issue more stock for its current business, okay, that might provide a higher rate of return to the investors, okay, than issuing stock or raising debt for a new product which has a higher risk. Okay, so the important point is that the current capital structure for Adidas or any company that's starting a new business is generally not relevant, okay, when raising capital for the new business. The new business generally has to stand on its own in terms of its risk, so forth and so on. Okay, so what Adidas might do, okay, they might compare, okay, their new business, okay, to competitors in that same new business, in this case, personal products, okay, and they might evaluate what the cost of capital and how companies in that business, okay, are raising capital. They would use that as a measure, okay. They then might apply two, okay, empirical analyses to the data they get from the other companies. The first would be the dividend discount model, okay, where they are looking at the cash flow from the new product, discounting that cash flow, okay, to see what kind of a return they would get for the new product. Or the other would be the capital asset pricing model, okay, where they are looking at the risk, the rate of return and associated risk and beta, okay, for the new product. Okay, so that's what they wouldn't do, and that's how they might go about establishing the cost of equity capital, okay, for the new product. Okay. The second question we're asking is, do you think this cost of equity capital, okay, will be similar to that of its core business? Okay, and the answer is no. This is a different business from the core sports business, okay, and it has a different set of risk factors. It has a low beta, okay, because it's a higher risk business, whereas sports guides are typically more cyclical. Okay, so using the core business would result in an overestimate of the cost of capital, okay, because, okay, the beta, okay, is lower for the existing business, and it is less risky. Okay, so now, then they ask us to suggest how they might estimate the average cost of capital. Okay, and here, the cost of capital is the weighted average cost of capital, and here, okay, they probably, we know that the weighted average cost of capital is an equation which has the cost of debt times the percentage of debt plus the cost of equity times the percentage of equity. In this case here, okay, the cost of debt, okay, would be the same, okay, for probably the company as a whole as it was prior to the personal services business, okay, because the main business would still carry the percentage of debt and the percentage of cost of the debt, okay? We see from above, though, the cost of equity, okay, would be different. Okay, so the weighted average cost of capital, okay, would be different overall for this new project, and we would probably be looking for a higher return on the project because the risk is going to be higher. We know on D, they're asking us how the rate of corporate tax affects our answer to C, and we know that whereas the tax rate does not affect the cost of equity, okay, it does affect the cost of debt, okay, because the cost of debt, you get a tax benefit and a tax shelter, okay, when we are using debt, because the interest on the debt, okay, is pre-tax. Subtract the interest from the overall earnings, and then you multiply that times the tax, so you're getting a tax shelter, okay, by using, by taking into account the corporate tax effect, okay. They also point out that that where the company, okay, is based would be significant because the tax rate is going to be different based on the company. Okay, finally, okay, they're asking us to discuss the factors that will influence Adidas and how it chooses to finance the new venture. Okay, so some of the things that would be considered would be the corporate tax rate, okay, the personal care business, okay, is more than likely going to be more of a steady business throughout the year, so the cash flows are going to be less cyclical, whereas people generally are going to be buying sporting goods, okay, and sneakers probably more during the summer and therefore be more cyclical. Okay, the fact that the personal care is more steady, okay, would give us a possibility of increasing the debt capacity in the long run. In the short run, okay, while the business is being established and it might not, we may not want to increase debt, okay, at that point, okay, we might use internal source of capital or consider equity capital. Okay, so I think that would be enough for, that'll give you